Look, I'm going to show you something that most financial creators would never put on the internet. My actual brokerage account statements from a period where I made every single mistake in the book and watched $10,000 disappear in 6 months. Not because the market crashed, not because I got unlucky, but because I did exactly what most people do when they're excited about investing and think they've finally figured it out. And here's the uncomfortable part. I had read the books. I watched the videos. I thought I understood what I was doing. But there's a massive difference between understanding something intellectually and actually having the emotional discipline to do it when real money is on the line. So today, we're going through every mistake, every bad decision, every moment where I convinced myself I was being smart when I was actually being reckless. Because if I can save even one person from losing their first $10,000 the way I lost mine, then putting this on the internet is worth it. My name is Auric, and I spend way too much time thinking about the psychology behind why smart people make terrible financial decisions. If you're someone who's either already started investing and feels like something isn't quite adding up, or you're about to put serious money into the market for the first time and want to avoid the mistakes nobody talks about, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. All right, let's get into it. So it was March. I had just turned 24. I had saved up $10,000, which for me at that time was a massive deal. That was 8 months of aggressive saving, cutting out restaurants, picking up extra work on the weekends, the whole thing. And I was proud of it. I felt like I had finally built the foundation that every financial book talks about. And I remember sitting at my laptop thinking, okay, this money just sitting in a savings account earning basically nothing is a waste. I need to put it to work. And that thought, that specific framing of putting money to work was actually the first mistake, because it created urgency where none existed. Here's the thing about urgency and investing. They are almost always enemies. Every single time I made a decision quickly in this 6-month period, it cost me money. Every single time I slowed down, I either broke even or came out ahead. But I didn't know that yet. So, mistake number 1. I put $3,000 into a single stock because I had done quote-unquote research. Now you might be thinking, that doesn't sound that bad, research is good. And that's exactly what I thought. But here's what most people don't realize about the kind of research most beginner investors actually do. It's not research, it's confirmation bias with extra steps. What I actually did was, I heard someone talk about this company, I thought the product was cool, I Googled the stock, I saw it had gone up 40% over the past year, I read 3 articles that were bullish on it, and I decided I understood the investment. That is not research. That is a story I told myself to justify a decision I had already emotionally made. And there's actual data on this. A study from the University of California found that the more frequently individual investors traded, the worse their returns were. On average, active individual traders underperformed the market by about 6.5% annually. That gap isn't bad luck. That's the cost of overconfidence. And I was about to start paying that cost immediately. The stock dropped 22% in the first 6 weeks, not because anything fundamentally changed with the company, just normal market volatility. But I hadn't prepared for normal market volatility, because when I was doing my research, I was only looking at the upside. I didn't seriously ask myself, what happens if this goes down 25%? How will I feel? What will I do? And that question matters more than almost any financial metric, because the answer determines your behavior, and your behavior determines your actual returns. I panicked and sold, locked in a $660 loss, and then the stock went back up over the next 3 months. If I had done nothing, I would have roughly broken even. Instead, I lost $660 in 6 weeks because I didn't understand the difference between volatility and actual fundamental deterioration. Think of it this way. Imagine you buy a house for $300,000. The next month, your neighbor gets a Zillow estimate saying their house is worth $240,000 because the algorithm had a weird week. Do you immediately sell your house? No.
because you understand that one data point doesn't represent the actual underlying value. But with stocks, because we can see the price update every second, we treat every fluctuation like it means something. It usually doesn't. Okay, so that was $660 gone. But this is where it gets really interesting. And by interesting, I mean this is where I made everything significantly worse. Because after that loss, something shifted in my brain. I needed to make it back. That's it. That was the entire investment thesis behind my next 4 decisions. Not what is the best place for my money, but how do I get back to even as fast as possible. Psychologists call this loss aversion on steroids. We feel losses about twice as intensely as we feel equivalent gains. So a $660 loss feels like a $1,300 gain would. And when you're in that emotional state, you stop thinking like an investor and start thinking like a gambler trying to win back chips. I didn't recognize it at the time. It felt completely rational. It felt like strategy, but strategy based on emotion is just emotion with a spreadsheet attached to it. So, I put $2,500 into 3 speculative positions in the next 2 months, not because I had done serious analysis, but because I needed wins fast, and speculative positions move fast. One of them was a small biotech company waiting for FDA approval for a drug. Here's something I didn't fully appreciate at the time. The FDA approval rate for drugs in clinical trials is 12%. 12%! I was essentially putting $800 into something with roughly an 88% failure rate because the potential upside was exciting and I needed a win. The FDA rejected the application. Stock dropped 67% overnight. That $800 became $264, and I just stared at my screen for a long time. Now, at this point, I'm down about $2,000 in 3 months, and you would think that would be the point where I slowed down, reassessed, maybe moved everything into index funds and called it a lesson. But that's not what happened, because I still had $8,000, and my brain had now fully shifted into recovery mode. I didn't even see it as $8,000 I still had. I saw it as the money I needed to get back to $10,000. This is one of the most dangerous mental accounting traps there is. The money you have and the money you've lost are treated completely different psychological categories, even though financially they're identical. A dollar is a dollar, whether it's a dollar you saved or a dollar you need to recover, but emotionally they don't feel the same at all. So here's mistake number 3, and this one is the one I see most commonly and most painfully in people who are just getting started. I started using leverage. Specifically, I started buying options. And I want to be really careful here because options aren't inherently evil. They're actually sophisticated financial instruments that institutional investors use for very legitimate purposes. But when a 24-year-old in recovery mode starts trading options because he watched a few YouTube videos about them, the outcome is fairly predictable. I put $1,500 into call options on a tech company ahead of their earnings report. The company beat earnings, the stock went up 4%, I lost $800, and I could not understand why. I was right about the direction, and I still lost money. Here's what most people don't realize about options. There's a concept called implied volatility, and what it means in practice is that the market essentially prices in its expectation for how much a stock will move around earnings. If the actual move is smaller than what was expected, even if it's in the right direction, the value of your options collapses. The market knew earnings were coming. The excitement was already priced in. I walked into a casino and bet on the most obvious hand at the table and wondered why the odds weren't in my favor. That's $800 gone on a trade where I was technically right about the direction. By month 4, I'm down roughly $4,500. I still have $5,500 left. And at this point, something strange happened. I started becoming weirdly detached from the numbers, like they stopped feeling real. And I think this is actually a really important psychological warning sign that most people don't recognize. When money stops feeling real, you start taking risks you never would have taken with money that felt real. It's the same reason people overspend more on credit cards than cash. The psychological distance from the actual value of money changes your decision-making in ways you can't fully see in real time. I moved $3,000 into a cryptocurrency that someone in an online forum described as the next Bitcoin. I don't need to tell you how that went. Over the next 8 weeks, it lost 74% of its value. That $3,000 became $780. So now we're in month 6. I've got roughly $3,200 left of my original $10,000. I've lost $6,800 in 6 months through a series of decisions that all felt logical and justified in the moment, and that in retrospect form a very clear pattern of psychological errors compounding on each other. But here's the turning point, and this is the part I actually want you to take something from. I stopped. I moved everything that was left into a simple S&P 500 index fund, not because I had a brilliant insight, but because I had run out of ideas and I was exhausted. And that exhaustion turned out to be the most valuable financial tool I